Her research focuses primarily on tax law and policy, particularly on the intersection between tax law and EU constitutional law, tax law and public economics, and tax law and criminology. She's published widely on these areas, including 4 books and over 60 journal articles and books chapters. She's also a visiting professor at the University of Lisbon, and she's held visiting positions at NYU Law School and ATAX at the University of New South Wales and Sydney, Australia. She teaches or has previously taught in programs offered at Católica Global School of Law in Lisbon, Leiden University in the Netherlands, and Oxford University. She's been tax policy and legal advisor to the Portuguese government and to the government of Timor-Leste, and has provided tax policy advice and or legal drafting advice to the governments of Sao Tome and Principe and Turkey under the auspices of the IMF, and assisted with drafting of Angola's new VAT law. She was listed 2 years running in the Global Tax 50 by the International Tax Review as one of the most influential tax people in the world, and was co-recipient of the 2016 Outstanding Women in Tax Award by Tax Analysts. And she's featured regularly in general media outlets discussing developments in tax policy around the world. So we're very privileged to have her with us today, discussing her paper co-authored with Michael Walpole from UNSW on the impact of public perceptions on VAT rates policy. All right, Rita, do you want to start your PowerPoint?
Yep. Okay. Okay, can everyone see? Okay, I can't hear the responses, but I see the nods, so good. Okay, so this is the first time I'm doing a seminar online, so you're not my guinea pigs. I hope it will go okay. This paper essentially, it looks at the political economy of general consumption taxes, and essentially it seeks to explain why there is so much resistance to what we know broadly is the right policy in terms of VAT rates and more general VAT base. Now, I'm going to concentrate primarily on the VAT model, European and Australian model, as well as adopted all over the world. But what I'm going to say actually also applies to the retail sales tax in the US to a large extent. So in general, this is about the political economy of consumption taxes rates, as opposed to specifically about the VAT. Okay, so I'll do some just general considerations on why do we think that these taxes are regressive, and then how we have tried to address the regressivity of the VAT, the traditional approach that is used in Europe and it is used in many countries around the world up to 1980, broadly speaking. And then the modern approach to addressing the regressivity, that is the kind of Australian model, and it's also used in New Zealand, Canada, etc. And then I'm going to draw some conclusions about the public perceptions point. So what do these experiences in Europe and in Australia tells us about the political economy dynamics of VAT rates, and how could we deal with those political economy dynamics. So the first point is, in essence, whether VAT is regressive. And there has been a lot of discussion, particularly in the US, as regards this issue in the context of the discussion of around wealth taxes, because there is a lot of, there are many people proposing wealth taxation. Others saying that actually the better way to tax the rich would just be to have a general consumption tax, VAT, broad-based VAT tax. So this is a discussion that it basically concentrates on the regressivity of the tax, and it is one that that sometimes is misunderstood. So I'll start by saying my conclusion, which is general consumption taxes are regressive, but are not as regressive as we probably think they are. So general consumption taxes are in essence regressive to the extent that you consume everything. So all of your income is consumed, then they are not regressive. But from the moment that you start saving, then it becomes regressive. So in essence, so if you have two people, one earns 100 and the other one earns 1,000, if they consume the 100 and the 1,000 in totality, the tax won't be necessarily regressive. It will be a proportional tax. They will pay part of the proportion of their income. The 100 will pay 20% of their income. The 1,000 pay 20% of their income. So the tax is distributed amongst them in a proportional way, similar to a flat rate income tax, right? So the regressivity kicks in once there is a C person that doesn't earn 1,000 but earns 10,000, and that person starts saving. At that point, that saved income is not taxed under a general consumption tax, and at that point, it's when regressivity kicks in. Now, a lot of economists will say that in essence, this is deferred consumption. And so it's the deferred consumption over your lifetime. And to some extent, this is true. But first of all, some of the savings could be so big that you actually could be talking about deferred consumption to different generations. And second, you really want to have a tax that catches the income in a relatively small time span. So we shouldn't really be talking about 20, 30 years expecting that income to be taxed. So in essence, the general consumption tax, the graphics that you're looking at is a stylized representation, just for illustration, prepared by an economist who I have a paper with, not this paper, not Michael Walpole, but Arthur Swistak. And Arthur basically just tries to show in essence how up to a certain point on the income distribution, you consume all of your income. At that stage, you have a proportional tax. From the moment you start doing the savings, up broadly speaking, after the third or fourth decile of the income, that at that stage, the regressivity problem kicks in. So how do we address this regressivity? The traditional approach of addressing this regressivity has been to remove things from the tax base. So we apply reduced rates of VAT or GST, or we apply exemptions to reduce the regressivity. So we try to remove from the tax base the things that we regard as essential. That includes food, usually utilities, gas, electricity, that type of things. And in essence, the idea is that if you reduce the tax, the price will come down, and therefore people that are on the lower income brackets are protected from paying that tax. Now, that traditional approach is broadly used in Europe. So all of Europe applies more than one rate of VAT. Some countries within Europe apply more rates of VAT than others. If you look at the VATs that have been applied from 1980 onwards, then you see that there is a lot less use of reduced rates of VAT. But even in those countries that tend to apply a single rate of VAT, you have exemptions. So the idea is exactly the same, a different tool, but the idea is the same, diminishing the regressivity of the tax by removing something from the tax base. What is the problem with this traditional approach? The problem with this traditional approach, if you kind of do a cost-benefit analysis, is in essence that, first of all, we don't really know that this approach works. And the second is that even if it does work, it carries massive costs. So starting with the problem of whether we don't know that if it works starts with an issue, what we would call the incidence problem. So we don't really know that if prices come down when you apply reduced rates of VAT or exemptions. So there is extensive evidence now, empirical evidence, that demonstrates that even if you reduce the rate of VAT or RST would be the same, if you reduce the rate, the prices don't necessarily come down. So the tax saving is not passed on to consumers or not all of it is passed on consumers in decreased prices, but a lot of it is absorbed in other parts of the production chain. Where it goes, there is some discussion, but broadly speaking, it seems that the majority of savings goes into the retailers. So when you reduce the rate of VAT, either in exemptions or in reduced rates, the biggest beneficiaries on all the studies that we have carried out tend to be the retailers. Now, this doesn't mean that it never comes down, that it's never passed on to consumers. It just means that every time that we have tried to test it, we have come up with empty-handed. So it doesn't mean, we can't guarantee that prices will never come down because it depends on price elasticities in various markets. But what we do know is that when we have tried to measure this, we have witnessed the prices, the rate of passing on to consumers being low. But even if we assume that they are passed on to consumers, so even if we assume that prices are come down and the exclusions from the base do work, and if we look at the distribution, we realize that in essence, who benefits the most from those exclusions tends to be the richest people in society. So what you're looking at right now is the distribution of savings in tax from exclusions from the base divided by quantiles of income in any society. So what you see there is in essence, number one are the 20% poorest in that specific society, and the number 5 that you see is the 20% richest in that society. Now, these graphs were prepared by an economist, colleague of mine, using data of a real country. I can't tell you which country it is for confidentiality reasons, but these are real data based on household consumption data and basically distributed across the production, the income distribution of that society. So what you see is even of essential goods, if you look at those graphs, is that even on those, the majority of the consumption is made by the richest people, the 20%, so the quantile, the top quintile of the income distribution. So in essence, this is once you think about it, it's kind of intuitive. So what you see in essence is that it's not that when our income increases that we consume more in quantity, but we spend more money. So if there is no tax on those products, you save more. So the majority of the savings, assuming that the incidence is right and the savings are passed on to consumers, the majority of the savings, when we remove things from the tax base, go into the richest people in society. So in the paper that I have parallel to this one with Arthur Swistak, we look at consumption patterns on household consumption data from 3 countries with different income levels. And we basically reached this kind of the 3 kind of conclusions. So the first is that broadly speaking, the consumption patterns mean that the benefits from reduced rates and exemptions go primarily to the 10% richest in society. So this means in essence that when in certain products, when you apply reduced rates or exemptions, you actually increasing the regressivity of the tax system as opposed to decreasing the regressivity. So if you think about private healthcare, private education, merit items like books or cultural events, if you look at those items, the regressivity actually increases when you introduce reduced rates of VAT or exemptions. And this is because only the richest people in any society will consume this type of goods or services. So it is only the richest that will consume private healthcare or private education. It is only the richest that will consume books or cultural events. So if you remove the tax from those items, it is only those people that will benefit. But interestingly, even when you look at the food and other essential products, what we see is that some regressivity may sometimes even increase on those situations. So it doesn't always increase, depends on the consumption patterns on that specific country. But even on essential products, regressivity may increase if you remove the taxation. So these are the benefits. So at best, the benefits are dubious, and if they are accrued, they tend to be accrued by the richest. And then there is massive costs. So starting with the revenue. So we spend a lot of money removing things from the tax base, right? And the issue is whether that money could be better used protecting, in other ways, protecting those poorest income households. And in this regard, it's interesting also that to note that the majority of public services benefits mostly the poorest. So we know this from public finance studies. So when you remove things from the tax base and you incur a tax expenditure, you're potentially removing money that could be spent on public services to protect the poorest. But even beyond the obvious tax revenue, you have loads of other problems, what I would call spillover effects. So you have loads of qualification problems and economic distortions caused by the fact that you treat two products that are similar in different ways. You have loads of opportunities for planning and fraud, and you obviously have loads of administrative costs. Now, what you're seeing now on the screen is examples of court cases that actually have existed. One of the most famous cases in Europe is this Jaffa Cakes litigation that happened in the UK in the 1990s to know, in essence, whether that product called a Jaffa cake should be regarded as a biscuit or as a cake. And if it was a cake, would be a 0 rate of VAT, and if it was a biscuit, it would be a standard rate of VAT, which at the moment in the UK is 20%, but at the time it was 17.5. You also have loads of litigation concerning ebooks. Different European countries treat ebooks in a different way. The truth is that there is enough similarities to regard them as books, but enough differences to also not regard them as books. So we actually don't know how to treat ebooks as regards VAT consumption. Then you have a case of Pringles. There is a big litigation also going back to the late 1990s, early 2000s about whether this should be regarded as potato crisps or not potato crisps. And one of the most recent cases called the tampon book, whereby in order to avail of a reduced rate applicable to books, tampons were now being sold inside books. And as a form of tax planning. So all these cases essentially demonstrate not only the qualification problems, but the scope for manipulation and the real difficulties. Sometimes it's not really a question of avoidance, it's just a question that you really don't know on the basis of the legal definition, whether you should regard something as A, which is subject to a reduced rate, or B, which is subject to a standard rate of VAT. So what you have with all of this is massive administrative costs and massive compliance costs. So the traditional model, broadly speaking, carries dubious benefits and carries massive costs. So from 1990 onwards, we started seeing countries around the world adopting the modern approach. So one single rate of VAT, broad base of VAT, but we address the regressivity through the expenditure side. So you collect all the money and then basically do welfare transfers to the lower income households. So this was introduced first in New Zealand and then basically spread in various other countries around the world that use this, sometimes in a kind of sectorial approach, other times in a general kind of approach. So to all goods and services, or sometimes only to specific goods and services where you have this transfer. You also see this kind of problem, which is in essence, developing countries haven't been able to do this as well, because a lot of them don't have welfare transfer systems that are sophisticated as developed countries. So you see this dichotomy around the world between countries that have from VATs, more recent VATs from 1980 onwards, you have this division between developed countries, which are able to do welfare transfer, versus developing countries which are less able to do welfare transfers. But this modern approach carries problems. First of all, there is this targeting problem, which is particularly difficult in developing countries, but is in general an issue, which is how do you target people on smaller incomes? But more than anything, what we have seen, and primarily if you look at the European example, is that is not really so much a problem of not knowing how to transfer money, is that there is massive political economic constraints. Countries cannot pass this message through that it is a good thing to tax everyone and then do only targeted transfers. And so this has been puzzling me for quite some time. So I have been working on this area of VAT base for years, and I just couldn't understand for a long time, why do people persist in supporting reduced rates of VAT and exemptions when it clearly is not a good way of helping the poor? So what is that is preventing people from adopting a different approach? So if you look at kind of the big picture, you will see that in Europe, we actually, instead of adopting the base broadening measures, we actually have been decreasing the base. So it actually is completely counterintuitive. So you see evidence showing that reduced rates of VAT and exemptions don't necessarily work and carry massive costs. And yet we have seen narrowing measures across Europe throughout the last 40 years, rather than base broadening measures. And the experience is similar in Australia. Australia started their VAT with only zero rating food, but even they have felt a massive pressure to narrow more the base more, and more very recently, last year, the government has succumbed to the pressure and has narrowed the base as regards sanitary products. So what is it? Why are governments so reticent on doing this? It's because people have very adverse reactions to attempts to broaden the base. So there is what you're seeing on screen are examples of situations where the government has tried to broaden the base and has suffered massive opposition, or it has suffered pressure to narrow the base. So one key example is the UK's pasties tax. It's how it's known here. So the government attempt about 15 years ago or so of introducing a standard rate of VAT to all takeaways and catering services. Now you would think that that wasn't necessarily an essential product. So you would think that that wouldn't have a big opposition. But in reality, it was massively opposed. The idea, in essence, was that takeaways were used by people on lower incomes when they purchased what became known the pasties. Pasties are something about this size that looks like a calzone, and it's like a folded item, and inside it has meat. And it was regarded as kind of a wholesome food that working people that do manual work would eat. So the idea, in essence, was that once the government tried to tax these takeaways, that essentially it was trying to tax working people in the UK on the lower incomes that were purchasing pasties. So it became known in the media as the UK's pasties tax, even though it applied to a range of products and to a range of takeaways, and the whatever income the government of revenue the government would get from pasties would be very, very small. And what it would get from catering across London in various expensive venues would be much bigger, but it became known in the media as the pasties tax. Another interesting example is what is happening with tampons. I gave there the example of UK and Australia, but in truth, this discussion is happening also in Canada, is happening also in Germany, which is whether, in essence, the application of a standard rate of VAT to tampons constitutes a gender inequality issue. And this has been an ongoing discussion. Now, the amount of tax that is paid on by each one a year on tampons is relatively small. People have done the calculations. We're talking very small amounts of money, but this has been personalized to made it sound like a gender issue. And I'll go back to this example because I actually have evidence that how this has been used, particularly by lobbying companies, to introduce a reduced rate of VAT. So what is happening? So why is there so much opposition to broadening base broadening measures? So for me, it's starting to think of this what is going on. It all starts with what the literature would call an information asymmetry problem, right? So majority of people don't really know that the benefits accrue to the richest if they exist at all. So it starts with an information asymmetry problem, right? And this information asymmetry is completely rational. So we, the public, can't know everything about everything. So we make decisions on the basis of very small amounts of information. It's not rational for us to get informed about every public policy. So the majority of people don't really know the details of tax policy. So what they go with is with instinct. And instinctively, it sounds like you would, from a tax perspective, you want to protect food, right? So if you ask anyone who is not a tax expert, and if you ask them, should we tax food less? They would say, oh, of course we should, because it is the instinct is that this works, right? So it starts with that kind of information problem. But the second level then is that basically that information asymmetry, what I have witnessed is that it is basically used by lobbying groups. So what you see is essentially companies that manufacture some of these products, then using it. And a very concrete example on going back to the tampons is an experience that I had recently with students. So I was teaching a class with students from all over the world, and there was amongst the students was a German student. And when I was talking about these issues, she raised her hand. And she said, oh, I have an example. And I thought she was going to say that in Germany, this issue about tampons is also a big discussion, which I knew that to be the case. But actually, when she raised her hand, what she said was something completely different. What she said was that she had a friend that worked in the tampon sanitary production industry. And they had been using NGOs to basically lobby for lower rates of VAT on tampons. So she, in essence, said, you know, so what they basically want lower rates for their products. So they have been mobilizing NGOs to dress this issue up as a gender issue, as opposed to I don't want to pay tax issue, right? So, and this goes to my kind of final point. So then this is really about framing. So no company is ever going to tell you, oh, I want my products to be lower taxed. So those that produce sanitary products are not going to be saying, we want lower rates of tax for our products. There's also very interesting examples on other industries. I personally witnessed something similar to with restaurants in Portugal many years ago, of also kind of lobbying for lower rates of VAT. And of course, they're not going to say it's because we don't want to pay taxes. So you basically dress it as a fairness issue. So if you are the takeaway industry or the catering industry, you dress it up as, oh, this is about protecting the poor working class people in the UK that are eating pasties. If you are producing sanitary products, you dress it up as a gender issue. You want to really, what you want is to protect the gender equality. You don't really say that you don't want your products to be highly taxed. If you are in the restaurant industry, you're not going to say, I don't want to pay taxes. What you're going to say is, oh, I'm trying to protect the jobs in the industry, etc. So what you see is basically each industry dresses up the framing as the fairness narrative. So it is never really about paying lower taxes. Is it about a much wider issue of fairness? And this works because we humans, and we know this from behavioral science, we humans strive for fairness. So this is why we root for the underdog in films and so on. We root for fairness. So once the issue is framed as a fairness issue, being it protecting the poor, being it protecting employment, being it gender equality, etc., we instinctively, if we don't know any better, and this goes back to the information asymmetry problem, if we don't know any better, instinctively, we buy into that narrative. So then you would say, and I thought for a long time, so just inform people, right? So we combat the information asymmetry and you explain to people that this doesn't work. So, And I try this, and it does work to some extent. Some people are convinced, but it doesn't work completely. So why is it stopping then people? And what I've realized is that there is a level 2 to the political economy problem. So even if you inform people, then you have an issue of disbelief and loss aversion. So what we think in essence is, okay, so this is not working, but what if what comes afterwards is worse? So we basically are fearful that we now put the rate of VAT up, or the rate of RST up, but then the government doesn't do welfare transfers. So in essence, we have what in cognitive science is known as a loss aversion problem, right? We don't want to give up on what we have because we're fearful of what is, we are skeptical about the two-step policy. We are worried that the first step is going to take place, but the second step, which is to do the welfare transfers, is never going to happen, right? So you have these two levels. First of all, people don't know, and that information is exploited. And then even when you tell them, they basically have loss aversion, and they are worried that the second step is never going to happen. So how do you deal with this, overcoming the constraints? So first of all, it's combat the information asymmetry, and in my experience, to have a counter narrative of fairness. So to say that, oh, we're going to remove distortions to competition and so on, or you were going to increase GDP or whatever, is not really going to work. So you're going to have to counter the narrative of fairness with another narrative of fairness. So this is about gender equality. No, actually, really what we should be doing is to collect money on tampons and then give tampons for free for people on lower incomes, or give them for free in schools, for example, etc. And then the level 2. So how do you overcome the skeptic and the loss aversion? And on this, there is various possibilities. So first possibility is that you have a lock, right? You introduce the legislation together. You introduce the welfare transfer at the same time that you increase the rate of VAT. But sometimes people don't believe it either because they are worried that it's going to be removed at a later stage. So you put the lock now, but at a later stage it's going to be removed, right? So we have a proposal. So in another paper on parallel paper on how this could be addressed was through a progressive VAT, what we call a progressive VAT, which is in essence we make the welfare transfer instantaneous in real time, using technology that we now use for anti-fraud. So when you go to a shop, you give your tax number, and at this moment in time, we use that real-time information to combat fraud. But what if we use that real-time information to give the money back immediately to people, right? So you would have like a digital wallet, and in essence, if the system identifies you as a lower-income household, then immediately that money is going to be transferred again to your digital wallet. Another thing that we witness in this paper is that looking at Australian and European experiences is that often it works when you have external pressures, right? So the situations where there has been a base brought up have all happened in the context of the financial crisis, or when there is an outside, what I call here the external culprit, right? So if you have an external pressure, something else is happening, then it might be easier. But in broadly speaking, the removal of the time lag between the level 1, which is to remove the current benefits, and the level 2, which is give different benefits in the form of wealth transfers, I think, and Arthur and I think is going to be the game changer. So that is it. I hope I didn't go over time. Thank you so much for keeping with me in my first experience with giving a seminar on Zoom, and look forward to questions now.